Factor investing is based on empirical research dating back more than 40 years. Its popularity has grown steadily over time, but it started to attract more attention after the global financial crisis, as prominent institutional investors embraced more systematic approaches to portfolio construction. Factor investing is a term often used interchangeably with quant investing and smart beta, but there are very important differences. In a nutshell, factor investing is a form of rule-based investing that seeks to exploit persistent, academically proven equity premiums. The term factor, or more accurately risk factor, refers to attributes that have been shown to explain the return and risk of associated securities over the long term. An important concept to grasp is that factor investing is not designed to beat the market, but to deliver improved risk-adjusted returns. Depending on their needs and priorities, investors can use factors defensively to control potential losses or offensively with a view to maximizing returns. Research into the different factors that explain investment returns began in the 1970s. In the early 90s, Gene Farmer and Ken French introduced their three-factor model, which underlined the benefits of tilting equity portfolios towards value and small cap stocks. Since then, literally hundreds of purported factors have been identified, but only a very small number of those have been shown to be robust over time and across different markets. In a paper published in 2017, Elroy Dimson, Paul Marsh and Mike Staunton narrowed down the factors the investors should focus on to size, value, income, momentum and volatility. Factor investing does have its critics. There's no guarantee that just because a particular factor has worked in the past, it'll continue to deliver a premium in the future. There are bound to be periods of underperformance, some of them protracted. For example, of all those factors we just mentioned, only one, momentum, has actually outperformed over the last decade. But the very long-term data in favour of factor investing remain compelling. Factors perform independently of one another and can be successfully blended. Multi-factor strategies have comfortably beaten the broader market over long periods. They've also had a higher Sharpe ratio. But different multi-factor strategies can produce very different outcomes, so implementation is critical, and it's not as straightforward as you might imagine. For a start, you have to select which factors to include. You need to choose suitable indices and the right funds or ETFs to track those indices. You also need to consider the relative weighting of each factor. Simple in concept, factor investing is complex in execution. How then does Sparrows Capital implement its factor strategies? Implementation is based on the following principles. Active risk is reduced by holding a combination of factors. Because factor timing is a fool's errand, factor tilts are static. Investments are made in separate vehicles, each targeting a specific equity factor on a global basis, giving flexibility to control which factors to include and what weightings to apply. Weightings are based on standard deviation of single factor excess returns, Sharpe ratios and correlations of factors. And finally, when deciding on the appropriate factor combination, the key criteria are risk and how factors correlate with each other. In summary, Sparrows Capital's factor investing philosophy is strategic, risk-based, diversified, and cost-efficient. The evidence shows that alpha is elusive. Most fund managers simply don't have the skill to generate value through stock picking or market timing. Those few managers who can add value tend to do so only over short periods and usually absorb most of that value in fees. Factor investing provides a superior alternative to traditional active management. By applying the findings of some of the brightest minds in academic finance over the last 4 decades, it is possible to produce higher risk-adjusted returns.